You're watching ET Markets Live only on the Economic Times. I'm Neha Vashisht Mahajan. Welcome to a brand new episode of ET Smart Investor, where we discuss everything related to your investments and much more. Today, we are going to discuss sectors that could shine or not in the current market scenario. To discuss more on that, we have Dr. Mukesh Jindal, Senior Partner at Alpha Capital, with us today. Thank you so much, Mukesh, for joining us today on ET Markets Live.
Thank you, Neha. Thanks a lot for inviting me to the show. It's always a pleasure to be here.
Great. Let's quickly start our session for today and let's start with what's happening in the markets right now. We've just started the week. Last week, Nifty and Sensex saw over 1% drop. How are you looking at the markets? Which way is it going right now? Is it a healthy correction? Today, I saw the markets have recovered a little bit. But what do you think about the markets right now? What's happening?
So, Neha, last week was an important week because we had the Iran and Israel crisis, and I think it has stopped the momentum of the market. Market has
Right.
been going up since April 7th, and in the last 2 months, market has gone up by 15-20%. So we were having a super run, and the
Hmm.
markets were going up because the problem of Trump tariff was behind us. The RBI has been cutting rates globally. All the central banks have been cutting rates. The government has been front loading the capex, so market was seeing a phenomenal run. Last week which happened, it came as a surprise because market was not discounting the Iran Israel crisis. It happened suddenly. Of course there were some rumblings, but what played out was a big surprise. And I think the Iran Israel crisis is going to impact market in a big way if it plays out. We don't know as of now how long it will play, how bad it will get. Because see, Iran is not like your Ukraine or Palestine. Iran happens to be the fifth largest producer of crude in the world. And
Right.
crude is an important commodity. Crude is an important commodity because most of the emerging markets will still import crude for our use. Like India still imports 80% of crude requirement from outside India. And in particular, it impacts India a lot because our bill, the import bill, is huge. And as per data, for every 10% hike in crude price, the India's current account deficit goes up by 0.5%, which weakens the rupee. The fiscal deficit goes up by 0.3%. There's an inflation which comes in. It also impacts the stock market. Now, if you look at the stock market last week, market started correcting on 12th of June. And then in the night, the attack happened. On 13th of June, the market corrected. We saw a correction of a total around 2% between the 2 days. Thankfully, markets are positive right now. Today, as we speak, your Nifty is up around 0.8%.
Hmm.
Now, how market will move this week will depend on what happens, Iran and Israel, how they play out. As of now, market is discounting that it's a local affair. It's not spreading, but we still need to watch because it's early days. And what we need to watch is whether this issue or the geopolitical tension is only
Hmm.
in the Middle East or it spreads. Because if Israel attacks the Iran oil fields, then the crude may go up to $90. And if Iran retaliates by stopping the ships which are passing through the Persian Gulf, then we may see crude going to $100. According to me, till the time crude is at $80, we are fine. As of now, the Brent crude is at $75. It has
Yeah.
gone up almost 30% since April, and last week it went up by 10%. So we need
Yeah.
to watch it. And generally, markets always react in the first few days of the crisis and it bounces back. If you look at the historically all the geopolitical tensions, market tends to bounce back. So maybe it's a short term, but we need to watch.
Right, absolutely. And last week also we saw that the crude touched around 78 level also, and there were fears that Iran could retaliate by blocking the Strait of Hormuz, which could ultimately, disrupt the global oil supply. But we are going to talk about oil and gas and crude a little later in the session. But let's start with the sectors first, and I want to understand from you which sectors you think are more attractive right now considering the global scenario in terms of war, US and India. everything. And let's also talk about defense. What's your take?
So what is happening, Neha? It's a very interesting situation. You picked up defense. Of course, I'll also talk about different sectors. The crisis which has been playing globally, since February 2022, when the Ukraine-Russia war started out, it's really sad that we are seeing so many wars. We have seen Palestine war, we have seen India-Pakistan conflict, and now we are suddenly seeing this. Wars are never good. It affects the innocent people, but unwantedly there are a lot of wars, and one sector which gets benefited the most due to war and geopolitical tension is defense. And if you look at defense as a sector in India, defense is playing out big time, because the Indian government has been focusing in the last few years to manufacture defense, because still now most of our defense capex has been by importing aircrafts and other defense requirements, but this government has been focusing to manufacture in India. So there are a lot of defense stocks, and if you look at the defense index is already up more than 50% in the last 3 months, and it's up in the last 2 years by 4 times. So defense has been the biggest beneficiary, and every time we see there is a defense crisis, the geopolitical crisis, the defense stocks goes up. Like a
Yes.
classic example is the India-Pakistan war. The defense stocks were going down, and immediately when the crisis played out, the defense stocks started going up. So personally, I like defense sector a lot, because India is determined to build this, and we have already seen a good success. We are seeing good exports of defense products outside India. Our missiles are in big demand, and we have the technology. When I say technology, the we have good brains, who have done really well for India. So I'm sure that we will be able to do good manufacturing in defense. The only challenge in the defense sector is the valuations. The defense stocks are not cheap. The defense index is trading at a PE of 75. So a lot of this information has already been discounted. So maybe investors should look at defense from a long term perspective, and should buy if there is any correction in defense. So this was about defense. Now talking about other sectors which I like, which I really think that may be negatively affected. I think if we have to look at short term, then we also have to look at the sectors which gets affected due to Iran and Israel crisis, because crude prices gets impacted, and I think the biggest indicator of the crisis will be the crude prices. Now there are some sectors which will be negatively affected. The negatively affecting sectors will be the sectors where crude is a raw material. So these sectors are your airlines, paints, tires, because the cost of goods goes up whenever the crude prices goes up, and the margin of the companies come down. The second interesting sector will be the oil and gas. And within oil and gas, we have to understand there are two types of companies. One are upstream, which are majorly in the production of crude, and then there are downstream, which are into refining and distribution. So historically, the upstream companies, the companies like ONGC and all, which are into the production of oil, benefit when the crude price goes up, because the selling price goes up, their margin goes up.
Right.
But the downstream companies like refinery and distribution, like BPCL, Indian Oil, they get negatively affected because the margin comes down. So oil, you have to investors have to play really well. Some sectors may also benefit. One is a pharma, because if the crude stays high, the current account deficit of India goes up, and the rupee weakens. When rupee weakens, the Indian exports become attractive, and pharma is one such sector which may benefit. So is IT. IT, has been correcting in the last few months. The valuations are pretty good, and with the rupee coming down, the IT may become attractive. Of course, there is uncertainty due to AI and high rates in the interest rates in US, but still, I think these two sectors are defensive. If the crisis plays out long, and if investors are risk averse, we see people moving to these two sectors. So this is a view on the sectors.
All right. Let's also talk about banks and NBFCs. Now, after RBI's recent support, RBI actually cut the repo rates by 50 BPS, totaling to a 100 BPS repo rate cut in 2025 itself. So, do you think that banks and NBFCs are back in focus right now? What's the opportunity here?
So RBI has cut the rate, Neha. You're absolutely right. They've cut the repo rate by 0.5% to 6.25%. This was a big surprise because market was discounting 0.25%, and they have till now cut around 1%. I personally feel that the RBI has been very hawkish since last 6 months. If we look at the crisis which Indian market we are seeing, I think this crisis is also self-made. See, the global economy was slowing down, the Indian economy was slowing down due to election year in 2024. The government was not being able to spend. The consumption was down, and because of which inflation was also coming down. Despite that, RBI was keeping very high rates for a very long time. So the real interest rates in India were high. If you talk to any business owners, entrepreneurs, the borrowing cost for doing any project was 10%. And with that kind of high interest rate, it becomes difficult for entrepreneurs to do new capex. Even the demand gets hit because people don't like to borrow when the rates are so high. So one, I feel RBI has been late in cutting the rates, and I'm also glad that they have cut the rate now in 2025 by 1%. And with inflation being now, the CPI being at 2.82%, I still feel that the real rates are significantly positive, and there is a scope of further rate cut. Now, when rate cuts happen, Neha, one of the biggest beneficiaries are the bank and the NBFCs. They are the beneficiary because generally, when the rates come down, the borrowing happens. People borrow money to spend. The personal loan goes up. People buy houses. The capex also happens. So definitely, the demand for loans will go up, and the banking and NBFCs will be a beneficiary. Of course, during when the rates come down, the NIM, the net interest margin, also sees some kind of compression. So they may have some kind of loss over there. But on the lending side, it will be interesting. But there are few points, Neha, which I want to highlight. See, in India, the credit offtake has been not happening for somehow, especially on the capex side. Now, those banks which are able to scale up the credit, disbursement, I think are going to be the biggest beneficiary. So, the companies, the banks which can really lend aggressively to the right people and ensuring that they have a healthy balance sheet, I think are the good banks and NBFCs which are good for investment. And on the, there are few sectors, when I say sectors, few segment of this sector where I'll be slightly careful. One is a microfinance, and the second is on personal loan. In this particular two spaces, the NBFC especially have lended aggressively, and now we are seeing good NPAs happening over there, and RBI has red flagged also on that part. So I'll prefer banks and NBFCs with good asset quality, where the NPA problem is less, balance sheet is strong, and where they can lend. Thankfully, the good news is that the valuation of private banks, the NBFCs, some NBFCs are still looking good. So this sector can be attractive and can benefit out of from the rate cut.
All right. Let's also talk about some sectors that you think could underperform in the near term due to maybe global issues or domestic issues. What's your stance on that?
So Neha, in the short term, there are few sectors, we are bearish, and those sectors where we are bearish are the sectors which are crude driven. And as I had highlighted earlier as well, one of the sector, where we are bearish is your, oil companies in the downstream, and which have the are getting exposed to the distribution and refinery. As I said, BPCL, Indian Oil, those are the companies, the oil downstream companies, we are bearish. And also the companies which have crude as a raw material, especially like airlines, tires, and paints. But this will start playing out if crude goes above $80. I think if the crude stays up to $80, I don't see any negative impact, because plus minus 10%, it really doesn't impact so much. The Indian economy, as per data, the crude starts hurting us more if the rate is more than $80. So we need to be careful about the sectors which are sensitive to high crude price. The second sector where I am, slightly skeptical is the FMCG. Somehow the FMCG, especially the listed FMCG companies, they are not seeing as high the sales growth, and the profit growth is not happening because the demand has not been playing out. And also we are seeing intense competition. There are a lot of private players which have come up, which are yet to be listed, but they are taking a lot of the sales as well. So FMCG is something, the sector which I'll be slightly skeptical. Again, those sectors, where there's a lot of technological disruption, one has to be very careful, especially auto, because there's a big change which is playing out. If you look at what happened to the Ola Electric in the two-wheeler, at one point of time they were leading the market, and suddenly they are struggling. So one has to be
Yes.
careful even in the four-wheeler. So of course the auto has a good attractive valuation, but there's a lot of disruption playing out. So you have to play auto very careful. IT is becoming attractive. IT is becoming attractive because the valuations have come down. It may benefit out of rupee devaluation, which is playing out if crude stays high. And also if the rate cuts happen more in US, and this Trump tariff is behind us, then we may see US companies investing more in tech and AI, and Indian IT will be beneficiary of that. So sectors are there which investors needs to be careful.
All right. Let's also come back to the markets and talk about FIIs and DIIs. So, in June, FIIs pulled back a lot of money around. If we talk about in numbers, 4,000, approximately 4,000 crore rupees were pulled out by FIIs, and but the surprising part was that DIIs bought 44,000 crore rupees of Indian equities in June. How do you think that that's helping the Indian markets, and what's your view on it? Because I think at one point in the history of Indian markets, a lot was dependent on FIIs, but now DIIs are the foundation of the Indian market. So what's your view on that?
Yeah, you're absolutely right. In fact, I still remember the days, 15, 20 years back, when we used to watch what FIs are doing. And because FIs were the main driver of the market. And in the last 10 years, this pattern has completely changed because DIs have also become very strong. Now, if we talk about the FI, DI, you're right, Neha. In fact, in June, the FIs have, been selling, and the DIs have bought 44,000 crore of investments in June. In June, particularly, the FIs were buying initially, but they started selling on Thursday and Friday, because of which the June numbers have become negative. But otherwise, they were net buyers in March, April, and May. That's why market has been doing pretty good. In fact, FIs sold record 3 lakh crores, Neha, between October 2024 and February 2025. So in 5 months, the kind of selling which FIs did was phenomenal. And this all happened because of the Trump coming in power, and there was an uncertainty, and there were tariff talks. And FIs are now coming back because as a tariff is behind us and everything is getting postponed, so FIs are more confident in the way to take risk. Now, talking about the FI and DI story, Neha, I think investors need to understand that the period which we are going through in the Indian stock market is extremely different. And this market is driven by liquidity. Over here, a lot of investors are confused because they feel that markets are so expensive. There's nothing cheap. And it's very difficult for those investors to do bottom up stock picking if they're looking for something cheap. And there is a reason for that. I think Indian stock market is supported by hand of gods. And when I say hand of gods is nothing but your mutual fund SIP, which is coming in the market. So currently
Absolutely.
we are seeing a monthly SIP of 27,000 crores approx, which is coming in. And this number, Neha, is growing at 30%. So today, if a fund manager gets 27,000 crore to invest this month, you just imagine 3 months down the line, 6 months down the line, 12 months down the line, he'll be having a much higher amount to allocate. So he's finding, the fund manager of a mutual fund is finding extremely difficult to be out of the market, even if the valuations are high. So despite FIA withdrawals, the markets are not getting impacted so much because of the support from mutual fund SIP. If the mutual fund SIP was not to be there, Neha, the market in the October to Feb period may would have tanked by 40-50%. We only saw a minor correction of 15%. We did not see a lot of correction. And I think, Neha, this trend is going to continue for at least next 10-15 years. And there are valid reasons for same. If you look at the equity mutual fund AUM as a percentage of GDP, in India, it is still at around 7%. The global average is 30% and US is at 72%. So there is a long way when India's mutual fund participation will only go up. And there has been a lot of awareness. We have seen advertisements of mutual funds sahi hai. We have seen simplification of investments, be it KYC through Aadhaar, and financialization and digitalization of investments, which is happening. So I think this trend will continue, Neha. It's a liquidity driven market, and I don't see that investors can be out of this kind of market. If investors are waiting for a deep correction, for the valuation to come down and then invest, they may be disappointed. So once you understand this, that there are hand of God supporting the Indian stock market, the dynamics changes everything.
Absolutely. I think COVID also brought a lot of knowledge about markets in general and mutual funds, and it is only going to increase in the next decade, as rightly said by you. Let's also talk about what's happening in the markets in terms of global macro triggers. What are the global macro triggers you think that could be in focus right now?
So Neha, if you ask me, India is one of the best countries right now, one of the best economies. Our financial systems are very stable. Our balance sheet globally is one of the best. Our fiscal deficit numbers are in control. Our current account deficit are in control. We are one of the fastest growing economy, which has a meaningful size. We are growing at 6.5%, and the last quarter growth was 7.2%. None of the global economies are doing so well. So if you ask me, India is in a very, very sweet spot. Okay, the only challenge in the Indian stock market which we are facing is that there's a lot of global uncertainty. The last 2 years, in fact, if you look at the markets, this was one of the worst period of global markets, because we had so many geopolitical tensions. We had high interest rates. So Neha, if you look at the global markets, the deposit rates in US and other developed markets today currently stands at 4.5%. The borrowing cost in dollar terms is at around 9 to 10%. And when you have this kind of high rates, it becomes extremely difficult for global economy to do well. And that's the reason why global economy has gone through one of the worst phase, and India has also been, seen some kind of impact of that. So if you ask me, what are the factors which, macro global factors which are impacting India and what investors need to watch out? First is the global interest rates. Global interest rates are not high because it hits the demand, it hits our exports, it hits the FI flow. See, if the FI is getting 4.5-5% in dollar terms, he will prefer putting the money in money market instrument rather than taking risk in emerging markets. So 4-5 years back, they were getting 0%, 0.5% or 1% in their deposits in US and other places. So it's very important that interest rates come down. Already the central banks, most of the global central banks are cutting the interest rates. And if the trend continues, I think this is going to be very important. And we soon have a US Fed meeting. If they cut the rate, which seems unlikely for now, then I think it will be very good. So one impact or one thing which investors need to watch is the global interest rates. Second immediate thing what investors need to watch is the Iran-Israel crisis. Iran being the fourth largest economy can have deep repercussions on global economy, because if Iran gets disturbed, because it's the fifth largest crude producer, and there'll be a hit on the global supply and crude prices will go high. As of now, market is discounting that the crisis is not going to be big, it's going to stay local. If it stays like this, then I think we'll be fine. But if it spills over, if the crisis goes long for weeks and months, I think it will hit the global growth. Third thing, what we need to watch is the Trump tariffs. Of course, the fear of the Trump tariffs has come down now. Earlier, he was saying
Yeah.
about big numbers. Now, the
Yeah.
negotiation is happening. But still, the base tariff will continue to stay at 10%. So, it will make the cost of goods higher for most of the countries, and it will have some impact. But yes, one needs to watch because you don't know Trump. Every night he's doing something else. So what he does, and because there's no science behind what he's doing, so one needs
Right.
to be
Right.
careful about that. Fourth interesting
All right.
development, which is
Yes.
the weakening of dollar. And because the dollar has been weakening, the dollar DXY index has fallen from 110 to 98. If it continues to weaken, then it should be good for the emerging markets.
All right. Uh, Now, just to close our session for today, one last query that I have for you is that if you had to pick just one sector to back for the next 6 to 8 months, what would it be and why?
See, personally, I would have loved defense, and because there's so much spending of government happening on defense and all this geopolitical tension, defense seems very promising. The only challenge I'm not being able to invest in defense is the high valuation. At 75p, the margin of safety is less, so defense is something which I'm currently avoiding, but it's in my watch list. If it falls, I'll buy defense. So since defense is not available right now because of high valuation, the sector which looks very promising is capital markets. When I say capital market consists of companies which is beneficiary of financialization of assets and digitalization of assets. So these companies are exchanges, these are your asset management companies, wealth management companies, depositories, and there's a good capital market index because, as I said, the mutual fund or the capital market or the stock market penetration in India is still very low, and there's a phenomenal opportunity. This sector will continue to grow, and I expect this sector to grow at 20-25% for next 10 years. The valuations are slightly stretched, but within that there are some good attractive investment opportunities. So capital markets seems to be doing well, and especially with RBI cutting the rates, investors are going to
Yeah.
get less interest in the FD, the fixed deposit.
Yes.
So they will be putting more money in equity and capital markets. So this sector is going to be beneficiary of that.
Superb. Well, this marks the end of our segment for today. Thank you so much, Dr. Mukesh, for joining us today on ET Markets Live and giving your valuable insights.
Thank you, Neha. Thanks a lot for the invitation, and thank you for the audience. Thank you to the audience. Yeah.
Thank you so much. Thank you, everyone, for joining us today. We'll see you next time.